All right, so why will interest rates stay low? Part 3, empirical application. We cannot directly measure anticipated life cycle average income, and therefore cannot directly measure the saver to borrow ratio. However, we have a way of approximating it because the savers and borrowers are generally in different age groups. I completely agree. While that relationship is not precise, the ratio of the number of households in the population groups thought to be in the net savings phase of life to those in the net borrowing phase of life ought to be a reasonable approximation of what we're trying to measure. As a first attempt to quantify this ratio in this paper, we use the group age 0 to 49, which would consume us, my wife and my family, as a financial instrument producing, i.e. the debtors, we're the ones in debt, the borrowing group, and the age group 50 to 75 is a financial instrument demanding, or the saver group. Look at this. Demographically derived saver to borrower ratios for the U.S. and Japan from 1920 to 2010. Look at that. Look at that. Look at that. Just, I mean, it's from 1975 to now, it's just taken off. I mean, we're this huge amount. Look at that. It's crazy. So you can see here the baby boom. It's basically stopping right here. And it's, what's that, 27 to, I mean, it's not even 1 to 1. It's not, sorry, let's keep reading. Look at that. It's just taking off, man. So here you got well more savers and borrowers in Japan. The ratio is calculated as a proportion of the population in the group 50 to 75 to the proportion of the population in the group 0 to 49. The ratio for the U.S. and Japan calculated by the author for 5 yearly data sets from the websites of the U.S. Census Bureau and the Japanese version of the Census Bureau are shown in Figure 1. So we got the ratio of the population in the 50 to 75 age group to the population of 0 to 49. And look at that, from 1975, I mean, basically, yeah, look at that, it's just this huge trajectory. The ratio of the higher, older people is just growing and growing and growing. For U.S., it leveled off to about 1995, and even with immigration, it's just jumped like crazy. And it gets scarier. The data for both countries show a very gradual change in the 20th century, with the common ratio for both countries in the 20s, and a convergence around 1980. Now, the interesting thing is, this is when Keynes and all those basic macroeconomic textbooks came out right here, right around there. Isn't that interesting? And that's when all that stuff on increasing population growth led to the Keynes and all those other guys that can think that was the basics for economics. There are a number of tests that might be useful to assess the novel way of looking at the evolution of the financial sector. The first is whether the saver-borrower ratio fits the bill as a variable to explain the difference in interest rates in different economies. The second is whether knowledge of a given country's saver-to-borrower ratio evolution over time provides an explanation of the evolution of interest rates in that country. From an economic point of view, 30 countries comprise 90% of the world on the GDP specifically. Specifically, if we use GDP as a yardstick, 30 countries together produce 90% of the world's income. So the first test is to which we put the ratio is, can it explain the observed dispersion of interest rates across this diverse group of economic producers. To test this, we use the 10-year bond yields in 28 countries from the Trading Economics website dated 23 December 2015. The 29th country, Argentina, has no data. So we substitute the 10-year U.S. dollar bond post on the website investing.com, which is projected to use the Treasury of Argentina bond. No bond yields were available in the Saudi Arabia either, so we only had it settled for 29 of the 30th countries. And you can see here, saver to borrower ratio, 2015. So we got South Africa, 0.17. 10-year bond is 10.2. Let's go to Turkey, 0.23. So it's all much, much more borrowers and savers. 10-year bond, 10.3. Israel, 0.25, 2015, 10-year bond, 2.09. China, 0.34, 2.94 is a 10-year bond. Norway, 0.42, starting to grow, 10-year bond, 1.43. Russia, Russia's probably an outlier because the economy is so jacked. United Kingdom, 0.45, 10-year bond, 1.84. France, 0.46, 10-year bond under 1. Sweden, 0.48, 10-year bond, 0.99. Austria, 0.5. That means they have So does that mean you got one or you got half? I think you had two. I can't. Was it? So you got 0.5. So that means you have two borrowers for every one saver. And in Mexico, you got 5 borrowers for every one saver. Canada, as you can see, look at this. I mean, Japan, 0.6, 0.275. Hong Kong, 0.54, 1.53. Canada, 0.51, 1.38. Hey. And so we got 10-year bond by the quartiles. The average 10-year bond in 29 largest economies arranged by saver borrower quartiles. So if you had the saver to borrower at 0.75 to 0.25, the average was 8.8 for the 10-year bond. The saver to borrower ratio is 0.48 to 0.6. Yeah, the average 10 years is 0.99. You can see the higher the saver to bond borrower ratio, the higher the saver to borrower ratio, the higher the average 10-year bond, but significantly. And we're talking significantly. The crudest test to determine if countries with similar saver to borrower ratio values have similar bond rates, and if groups with higher, the crudest, this is the test to determine that. In this test, we use the saver borrower ratio from 2015 to predict the 2015 interest rates. When the 29 countries are arranged in ascending order by the size of the demographic ratio, we found the average bond rates decline as the size of the ratio increases. In the lowest saver to borrower ratio quartile of countries, Brazil's bond rate is nearly 85% higher than the average, and Israel's bond rate is only 24% of the average level. In the second quartile, Argentina's rate is much higher than that of the other countries, having similar saver to borrower ratio, while the U.S. is much lower. Of course, the ratio of savers to borrowers is not the only determinant of bond rates. Sovereign debt interest rates also reflect creditworthiness. Argentina, Russia, Poland, and Italy clearly pay more because they're riskier performers as sovereigns go. If we look here, we'll take a look at where's Argentina. Yeah, Argentina right there, 15.69. We got Russia, 9.95. We got Poland, 2.86. We had another one in here. Mexico, I mean, you can see that those are the outliers because their economies aren't quite as straight as ours. All right, I think it was Hong Kong. I don't think Hong Kong. Anyway, let's keep going down. All right, so I want to show you this. I'm going to pass some of these studies, but I want to show you something here. Some of these politics will affect the 10-year bond rate. All right. Does a saver borrower rate explain the path of interest rates within an economy, within a country? A second sort of test of the hypothesis is an important determinant of interest rates is to see how well the path of interest rates within a country can be explained by the ratio. Japan and the U.S. were selected as the test cases. We tested both the World Bank lending rate for the period 1961 to 2010 and the 10-year bond rate from 1972 to 2010. The Japanese World Bank lending rate over a half a century are well explained by the ratio and the lagged inflation rate. These two variables shown in equation 3, yes, let's see, where's equation 3 right there? I want to show you this other one here. Let's keep going down. We'll scratch all that. This other one is going to be, all right, so what and why should we care? Hold on, right here. Yeah, I think this is going to be it right here. There's another chart I want to show you here. That might, hold on a second, because this chart's freaking crazy. All right, must be that. Terry Anderson, I remember him. All right, cool. Let's go back to this. I just want to show you this one chart, and we'll cut to the chase here. This is crazy. All right, so I'm going to go back to this one chart. All right, why should we care? Why should we care about the key findings of this paper is because the whole of the economic world is beginning to look demographically like Japan, with a higher and higher and higher saver to borrower rate ratio, i.e. more savers to borrowers. Table 2 records a demographic ratio for the 29 countries comprising of almost 90% of the world's GDP. The figures are divided into 2 columns. This is table 2. Yeah, right there. Oh, this is crazy. The figure is divided into table 2. The figure is divided into 2 columns. The dividing line is the value of Japan's saver to borrower ratio of 4.40%, in 1993 as the economy of Japan began to change rapidly. In his last presentation of the Bank of Japan, Masaki Shirakawa chose the topic demographic changes and macroeconomic performance. His talk is a catalog of some of the changes that the other countries of the world can expect to experience as they approach Japan's demographic milestones. These changes include slowing economic growth, deflation, low rates of return on investment, contraction, and loss of policy efficacy. Governor Shirakawa concluded his review of the Japanese experience with the following warning. The Japanese experience of a bubble burst tended to be underestimated as an idiosyncratic episode. Likewise, bystanders' apprehension about the ongoing demographic changes in Japan may, I fear, be falling short of the mark. My sense is that the full apprehension of the consequences of rapid population aging, coupled with a low birth rate, is yet to be seen in the light of the importance of the issue. Table 2 shows how close the rest of the world is to approaching the Japanese experience. In the first column, 90% the world aggregate. All right, so countries below, countries above. Japan in 1993, so countries below the 0.4 is what we're trying to look for here. All right, so the saver-borrower ratio is calculated by aggregating the population of the 30 countries as if they're one country, and is seen as aggregate right here. All right, 0.3891. 0.3891 is the aggregate. All right, so the aggregate in 2025 is 0.3891. The aggregate of the 29 right now in 2015 is 0.3039. Japan in 1993 is 0.4. So right now we're 25% below Japan in 1993, which is really the epicenter of when this started to change. In 2025, the aggregate of the 30 countries, or 29 essentially, because we don't know Saudi Arabia, will be right at where Japan was in 1993. And here we are, countries below, and right now, none of these are much of an economic powerhouse. South Africa, India, Mexico, Indonesia, Turkey, Brazil, Israel, kind of, Argentina, nah. China's above the aggregate of the 29. Thailand, again, not much. Countries above where Japan was in 1993. I mean, all the bigwigs, look at that, man. Average of the 29 today, weighted 0.4358. Japan in 1993 was the epicenter at 0.4059. The aggregate of GDP weighted. If you don't do the aggregate, just do the aggregate, not weighting, is at 0.3, not a big deal. But the ones below Japan are just nothing. The ones above Japan, when you weight them, are, look at that, is above where Japan was in 1993. And somebody significantly above. Austria, the Netherlands, China in 2025 will be at 0.5. Canada, France, Poland. Where's the U.S.? U.S. 0.43. Whew. But when we weight the country's demographic information by their share of the world output, the average moves to 0.4358, which is well beyond the value of the ratio where Japan's fortunes began to deteriorate. Well, the main story of that time of Japanese decline was related to the shrinkage of the workforce following 1995, the population contraction following 2007. Japan's central bank was roundly criticized by the U.S. and other central bankers for not doing enough to boost economic activity. Even Milton Friedman, when he was giving the keynote remarks at the Bank of Canada conference in 2000, castigated the Japanese for allowing recession to develop owing to an inadequate growth of the money supply. But perhaps the Japanese economic experience was due to inactivity by the Bank of Japan, maybe, but the saver-borrower ratio we've been discussing in this paper provides an alternative explanation, that by the early 1990s, Japan had entered the kind of asset markets where monetary policy was rendered powerless. Rendered powerless because of comparative shortage of potential Japanese borrowers to respond to the monetary easing which was being applied. That's what it comes down to. Japan had entered the kind of asset markets where monetary policy was rendered powerless because of a shortage of potential borrowers to respond to the monetary easing which was being applied. It was widely believed at the time that one of the effects of the Japanese monetary policy easing was to entice low-cost loans for developments in Thailand, Malaysia, Indonesia, and other parts of Asia, which contributed to the Asian fluke financial collapse in 1997. Lacking suitable clients of Japan, the banks have resorted to the foreign sector to try to take advantage of the lending opportunities provided by monetary policy. That explanation, that possible explanation for the Japanese difficulties also provide insight into the U.S. housing-based asset bubble which burst in 2007 and 8. The reason for the new bubble in 2000s of the U.S. was the discovery of a new group of debtors, the ninjas, no income, no jobs or assets, who were, it was alleged by the mortgage brokerage, adequate security for assortment of mortgage-backed securities. These securities and the mortgages were supported then, which supported them, were gobbled up by financial institutions around the world on the assurance that they were A-class risks. I'm not going to get in that, but anyway, I think that's this portends a future evolution of interest rates and the returns on other assets will be similar to the recent past. It means that the attempt by national governments to avoid the Japanese disease will be encountered by the same obstacles encountered by the Bank of Japan in 1990s and 2000. Look, I don't want to say it's scary stuff, but man, that is why the central bank is irrelevant. It really is. Stop with the central bank stuff. Anyway, something to think about. I got to think about what we should do in that regard, because I subscribe to this 100%. I did not used to. I subscribe to the Milton Friedman philosophy. The inflation is everywhere and always a monetary issue. There's too much money chasing too few goods. Well, you can do it the exact opposite too. Deflation is too many savers and not enough lenders and not enough borrowers. That's deflation. So you got too much money chasing too few borrowers. And it's because that's going to be deflationary. No, I agree. All right, I'll let that chomp on you guys. We'll see you next time.